Sometime back, I had done a video on analyzing the operating performance of a business where I explained in detail how to calculate the return on assets, the return on equity, and the return on invested capital, that is the ROIC. In this video, I'm going to explain the Dupont analysis. Dupont analysis is a very useful technique used to break up and understand the different drivers that affect the return on equity. The framework was popularized by the Dupont Corporation in the 1920s and has been widely used ever since by analysts. It allows investors to focus on the key metrics of the financial performance individually. Now, often a high ROE can be misleading, and here the Dupont analysis provides the exact picture to the investor about where the enhanced ROE is coming from. So the Dupont analysis breaks up the ROE into three different components. I'm going to explain this concept using a very simple example. Let's assume that I own a very simple business where I go and buy apples from farmers and I retail it at a profit. Now, in this business, the only working capital that I need is the inventory. So I use my cash to buy apples, and I have also invested in a second-hand pickup truck, which I use to go and buy the apples from the farmers, and I sell the apples directly from the truck. So it's a very simple business. So this is how the balance sheet and the income statement of the business looks like. I have just focused on the asset side of the balance sheet. I showed the asset side at the start of the year, then the full year's income statement, and the resultant asset side at the end of the year. Now, here just humor me and let's assume that the apples do not have any shelf life and they stay fresh for the full year. So I start the business with $50,000 worth of apples, which I bought from the farmers, and a second-hand truck, which cost $10,000. So my total assets is $60,000. In the year, I sold the entire inventory and generated $10,000 of gross profit. Let's assume my total operating expense, which involves depreciation, maybe some running expense, it's $2,000. The operating profit is $8,000 and the tax provision is 25%, which is $2,000. So I generated a net profit of $6,000. My ending assets look like this. The business generates cash flow from operations of $58,000. I'm not going into the detailed calculation, but you can see it. It's basically the net profit of $6,000 plus the non-cash expense of $2,000, which is the depreciation. So that makes $8,000 plus the change in working capital, which is $50,000, because the business started with $50,000 of inventory and ends with $0 of inventory. So $50,000 got released from the working capital change. So we have a total cash balance of $58,000 at the end, and the ending value of the truck is $8,000 because we had a depreciation of $2,000. So we are left with total assets of $66,000, which means during the year we worked with average assets of $63,000. The business does not have any debt, so the average equity is also $63,000. I'm ignoring the operating liabilities to keep things simple. So what have we got? Our net profit margin is 10% as shown here. The asset turnover, which is nothing but the total revenues divided by the average assets, that is 0.95. Asset turnover is nothing but the ratio of the revenues generated in the year using the average assets of the business. So essentially, how many times have we turned over the assets to generate the total revenues? So here we have turned over the assets 0.95 times. So the return on assets work out to 9.5%, and the ROA, the return on assets, can also be expressed as net profit over total revenues multiplied by total revenues over average assets. So algebraically, this is exactly same as net profit over average assets. Or in other words, the return on assets can be expressed as net profit margin multiplied by the asset turnover. So that works out to 9.5%. Now, the return on equity, as we have already seen, is nothing but the net profit over the average shareholders' equity. In this case, the return on equity can also be expressed as return on assets multiplied by the financial leverage. If the business does not have any leverage, which is in our case, the return on equity is almost same as the return on assets if we ignore the operating liabilities here. So this is what the equation looks like. The return on equity can be expressed as a product of the net margin, the asset turnover, and the financial leverage. Now, let's imagine a different situation where I'm okay with making slightly lower profit every time I sell the apples, but as a result, I get to sell the inventory much faster. So here, instead of having one cash conversion cycle in the full year, I end up making 4 cash conversion cycles. And in each cycle, my inventory of 50,000 gets sold out, but instead of making a $10,000 profit, I'm happy with a $5,000 profit. So in the first cycle, my revenue is $55,000 and my gross profit is $5,000. And then I reinvest my entire profit. And in the second cycle, again, I generate a gross profit of $5,000, so on and so forth. So in this situation, my total revenue actually becomes $250,000, which is basically the sum total of the revenues of all the 4 cycles. And the total cost of goods, which again is the sum total of the cost of goods sold in all the 4 cycles, that works out to $230,000. So I generate a gross profit of $20,000, giving me a EBIT of $18,000 after deducting the depreciation expenses. So my profit before tax is $18,000. My tax provision is $4,500. My net profit is $13,500. And again, I work out the ending assets. So using this scenario, I see that my net profit margin actually has come down to just 5.4%. But as compared to the 0.95 asset turnover in the first scenario, here my asset turnover has gone up to 3.75, which is the total revenue of 250,000 divided by the average assets of 66,750. So my return on assets actually go up to 20.22% as compared to 9.5% in the first scenario. So in this scenario also, we are not leveraging, so our return on equity is similar to the return on assets, which is above 20%. So you can see that while my net margin has come down, I have actually managed to significantly enhance my return on equity by increasing the number of times I turn around my assets. So the business has become more efficient in terms of asset turnover. So the return on equity can be expressed as a product of my operational efficiency, which my profit margin gives me, my asset use efficiency, which is how efficiently I'm using the assets to generate the revenues, and the financial leverage, which is the equity multiplier. Now, if I use some leverage, my return on equity would be higher than my return on assets. So let's bring everything together and take the example of these 3 companies. High MAR, where MAR stands for margin. So the first company has very high margins. The second company is called high turn. The second company basically has a very high asset turnover. And the third company is called high lev, which is a business that employs a lot of leverage. As you can see, all the 3 companies managed to increase their return on equity from year 1 to year 2. often what happens is we just focus on the return on equity and we feel great that, hey, the return on equity of our business is going up, so everything is hunky-dory. But the right way to analyze the business would be to look under the bonnet and ask ourselves the question, why is the return on equity going up? Now, in case of Himar, we can see that the profit margin has increased from 20% to 22.5%. So Himar has managed to enhance its net profit margin, and that is what has led to the increase in the return on equity, because the asset turnover has remained at the same level, and also Himar does not employ any financial leverage. So financial leverage also hasn't changed. In case of High Turn actually decided to reduce its selling price. Maybe it offered some discounts, and we can see that its profit margins have come down from 8% to less than 7%. But as a result, High Turn managed to sell its inventory much faster than Himar, and that resulted in significantly higher revenues and much higher asset turnover. So High Turn's asset turnover was already high at 2.33. Now it has gone up even higher. So the net profit margin has come down, but the asset turnover has gone up. And as a result, the return on equity has shot up from 21% to 22.5%. And here also we can see that the financial leverage has stayed around the same levels. In case of High Lev, there was no change in profit margin, and the asset turnover actually has come down. So High Lev has actually become slightly less efficient in terms of using its assets. But what High Lev has done is it has taken on some additional debt, and the company managed to control much more assets using the same amount of equity. So the financial leverage has gone up from 1.88 to 2.63, and that has been responsible for pushing up the ROE. So now let me ask you a question. So if you were given the option of investing in one of the three businesses, which one would you choose? So here you have to use your judgment, because now you know exactly why the ROE has gone up. So you have to use your analysis and your judgment to figure out which one is better suited. Now, personally, if you ask me, I do not like businesses with high leverage. So for me, High Lev is out. I will choose between Himar and High Turn, depending upon the industry, depending upon the nature of business. So there are many other factors which will go in this decision. Just by looking at this, I would not make a decision whether Himar is better or High Turn is better. I will look at a few other parameters which I have discussed in other videos to decide whether I'll go for Himar or High Turn. Now let me give you a real life example. Some of you who follow our research series, you would know that we have done a very in-depth research in this business, the China Maple Leaf, the Maple Leaf education systems. And we recently had a meeting with the CEO, and the CEO told us that their net profit margins are very high, and he sees that coming down. He doesn't see that as sustainable. So he expects the net profit margin to come down from around 40% levels to 25% levels. Now that was a shocker when he told us. But after that, based on the other information that he provided, we realized that while the net profit margin would come down, the asset turns actually will go up. Just to give you a simple example. Now, this business, they run multiple schools in China, close to 100 schools, and they also have a source of non-tuition revenues by offering summer and winter camps. But right now, they have a major capacity constraint. They have a total student population of over 40,000, but in a full year, they can only accommodate about 2,000 to 2,500 students for these summer and winter camps, which happen in Canada or US. They recently acquired this large residential property in Canada, they actually acquired two, one on the east side and the other on the western side, which will increase their ability to offer the summer and winter camps by almost 4 times. So what's happening here? Effectively, the margins will come down, but the asset turns will be going up significantly. Now, apart from this, they are also planning to introduce golf lessons because they have golf courses in most of their high schools. So through these additional services, through these additional sources of revenue, they are going to use the same assets which currently are there on the balance sheet to generate additional sources of revenue. So that will result in a higher asset turn. And my guess is that the return on equity will not shift much because of this offsetting effect of the higher asset turn multiplied by the lower margin. But of course, time will tell what the actual scenario will be. But this can be a good example of how the Dupont analysis is to be applied. I would encourage you to look at your own investments and try to see how the net margins, the asset turns, and the financial leverage has shifted over the years to see what has been the net effect on the return on equity. Thank you very much for your time.